We now know that there will be a lot of free money in the system because of this corona scare. But what will this free money chase? If there is money out there, it is going to chase something. Whatever it chases, one thing is clear, that inflation is going to return. Now I understand that inflation is one of the last things people have on their minds right now, but very soon this is going to become one of the issues because of this free money that is going to be printed unabated in the system. Now I want you to pay special attention to this subject, because whatever the free money is going to chase, inflation is going to show up there. It may not happen now, maybe not for the next 6 months, but it will return sooner or later. So what exactly will money chase? Well, in order to understand that, let's see what happened right after 2008. This is the US inflation chart of the last 10 years. As you can see, this moved somewhere between 0 and 4%, and invariably it stayed pretty close to 2% or so overall. Now even at this point of time, the inflation in the United States is about little more than 2%. As a matter of fact, if you look at, we are having 2012, let me just break it down to last 25 years. So this is where we are. About 2008, inflation actually went negative. Obviously, as a result of that reset, when the banks had to be bailed out, there was no growth. In fact, there was negative growth, as we can see here. But even as a result of more than $13 trillion printed, the inflation in the United States did not move a lot. So as a matter of fact, this inflation chart doesn't tell us much as to which sector, which industry the free money actually went to. But we know for sure that there are a couple of industries that have seen phenomenal rise in the last 10 years. So for example, let me go to the home price index. This chart shows the home price index for about last 70 years, which obviously has been increasing substantially. But what I want you to focus is the last 10 years right here. This is where the inflation started to rise. The price of the house price started to rise. So right after 2008, obviously because of the scare, the price of the house fell significantly, more than 20% or so. But right around 2011, obviously because of a lot of free money coming in the system, it started going in the real estate. Look at this. The median price of the US house in 2011 was about 175K. And in just 8 years, it went beyond $250,000. Now that's a significant raise because it's almost 30-40% raise. And this is the median price I'm talking about. So obviously, the free money that was in the system went into real estate. Now, it's important to emphasize that real estate is the largest industry in any economy. Just in the United States, the real estate sector commands about 17% of the overall GDP. So we can conclude that a lot of free money went into real estate, and therefore the inflation, the price index, going up. That was one part. Now I want to draw your attention to the stock market, I am at a Nasdaq Composite Index, and let's go back to about 2008 time frame. Obviously, there was a crash right here. But ever since 2009, the market has gone only in one direction, and that is up. Nasdaq, which fell to about 1400 or so points, went all the way to about 10,000 points, almost 7-8 times in the last 10 years. We can easily conclude that the free money in the system actually went into the stocks as well. And the graph tells the whole story. Now that was United States. What about the other markets, especially the emerging markets? Let's look at India, for example. This is 2008. The inflation was about 6%. Now, as a result of the free money being printed, the inflation went all the way till about 12% and beyond. And the high inflation regime stayed all the way till about 2014. That's a good 5 years of a very high inflation regime. So obviously in the Indian context, the free money that was in the system resulted in inflation, the overall inflation in fact, going up. And what happened to the Indian stock market? Well, this is Nifty 50, one of the indices in the Indian market. Almost the same story. It did fall in the aftermath of 2008, but ever since 2009, it went up. Not as much as the US market, but look at this. All the way from 3,000 mark, it went to about 12,000 mark. That's 4 times. Now remember, US was almost 10 times. The Indian market went up 4 times. Now that is the impact we are talking about. In the emerging markets as well, free money is going to induce inflation. People are not going to complain about it, by the way. Especially in situations like this. When the government is handing over money, people will definitely not complain. But what they will not realize is that somewhere, because of this free money getting into their hand, this free money is chasing something which is driving up the inflation. In some way, the governments would want to induce inflation. Why? Because it makes them look good. Now, when the inflation comes in, obviously every rupee, every dollar spent will be added in the GDP number. And therefore, the GDP as a whole will start looking up. Now that gives us a good feeling that the GDP is going up. Whereas what actually is happening is that all the free money is getting into GDP, assuming that more or less the growth, the development, the production is essentially the same, more money will be chasing the same amount of product. Therefore, the price of this commodity or any assets is going to inflate. And because nobody will complain about inflation, everybody will be happy because the prices of their assets or the commodities are going up. No one will care about the net growth. Now, this is the scary part. When the inflation is high and the real growth is almost zero, the GDP is going to grow at the rate of inflation. It means it is going to grow irrespective. But if you were to subtract the inflation rate from the GDP, that is the real growth. And in all probability, if the inflation is very high, the net growth is probably negative. But then that figure is not something we talk about. No one cares about the net growth.